Welcome to Money Depth Insights. I am the finance guide, Nell. Today, we are talking about why most investors lose money in the stock market, not because the market is unfair or impossible to understand, but because of how people actually behave once real money and real emotions are involved. Most people enter the stock market with good intentions. They want to grow wealth. They want financial freedom. They want better outcomes than savings alone can provide. What surprises many of them later is that the market itself is not what defeats them. Their own decisions do. One of the most common reasons investors lose money is timing mistakes. People believe success depends on buying at the perfect moment and selling at the perfect moment. This belief feels logical. In reality, it creates pressure to predict the future. Markets move for thousands of reasons at once, many of which are invisible until after they happen. Even when someone times one move correctly, repeating that success consistently is extremely difficult. Timing looks obvious in hindsight. It feels uncertain in real time. People wait for certainty before investing. They want confirmation that the market is safe, stable, and rising. By the time that comfort appears, prices have often already adjusted upward. Then they buy. When markets fall and uncertainty returns, fear takes over and they sell. This emotional pattern reverses the math of wealth building. Buying when things feel safe and selling when things feel uncomfortable is one of the most damaging behavioral loops in investing. Another major reason investors lose money is overtrading. Overtrading rarely comes from strategy. It comes from anxiety. People check prices constantly. They react to news. They feel the urge to do something. Action feels productive, even when it is unnecessary. Markets reward patience far more than activity. Most long-term returns come from a small number of strong periods. Constant buying and selling increases the chance of missing those periods. It also increases transaction costs, taxes, and emotional exhaustion. Overtrading feels like control. In reality, it creates instability. Another overlooked issue is emotional decision-making during volatility. Markets do not move smoothly. They move in waves. Drops feel threatening. Rallies feel exciting. These emotional swings push people into reactive behavior. When markets fall, people panic and sell to protect themselves. When markets rise, people feel confident and buy more. This behavior consistently locks in losses and reduces long-term gains. People do not lose money because they are unintelligent. They lose money because their nervous system reacts to uncertainty. Another pattern that causes losses is chasing performance. People invest in assets that have already performed well recently. They assume past success will continue. By the time something becomes popular, much of the growth has already happened. This creates a cycle of buying high and selling low across different assets over time. Another reason investors lose money is misunderstanding risk. Most people define risk as volatility. If prices move up and down a lot, they call it risky. Experienced investors define risk as the probability of permanent loss or long-term irrelevance. A volatile asset that grows stronger over time is not necessarily dangerous. A stable-looking asset tied to a declining business model can be extremely risky. When people focus only on short-term price movement, they make poor long-term decisions. Another behavioral mistake is abandoning strategies too early. Good investment strategies often feel slow at first. Progress is gradual. Compounding takes time to become visible. Many people quit before results appear. They switch strategies. They chase new ideas. They restart constantly. This interrupts compounding and increases the chance of mistakes. Another subtle reason investors lose money is overconfidence after early success. When someone makes money quickly, they often assume skill played a larger role than luck or timing. This leads to bigger risks, larger positions, and less caution. Eventually, reality corrects that overconfidence. Another problem is underestimating how difficult long-term consistency really is. People think discipline is easy. They believe they will stay calm during downturns. They believe they will not panic sell. When real losses appear, emotions take over. Without a clear structure, behavior changes. This is why systems matter more than motivation. Another overlooked cause of losses is information overload. Financial news is designed to capture attention, not support long-term decision-making. Headlines exaggerate urgency. Opinions conflict constantly. People who consume too much market news feel pressured to act. They react to noise instead of fundamentals. Long-term investors limit their exposure to short-term information. Another reason investors lose money is focusing on short-term results instead of long-term process. They judge success by whether an investment performed well this year. This mindset creates impatience. It encourages unnecessary changes. It increases emotional decision-making. Wealth is built through consistency, not constant optimization. Another behavioral trap is trying to recover losses quickly. After a bad trade, people often take bigger risks to make money back faster. This behavior usually makes things worse. Losses become heavier because they are followed by emotional decisions. Another issue is poor diversification. Concentrating too much in one asset, one stock, or one sector increases fragility. When that one thing struggles, the entire portfolio suffers. Diversification reduces emotional pressure. It makes patience possible. People also lose money because they confuse activity with progress. They believe doing more leads to better results. In investing, this is often false. The most successful investors make fewer decisions, not more. Another real-world observation is that people underestimate how much stress affects decision-making. When life becomes chaotic, money behavior becomes chaotic. Impulse decisions increase. Planning decreases. Financial mistakes often happen during emotional periods, not analytical ones. The market itself is not designed to defeat individuals. It rewards patience, discipline, and consistency. It punishes overconfidence, impatience, and emotional behavior. Most investors lose money not because the market is unfair, but because their behavior does not align with how markets actually work. The solution is not intelligence. It is structure. Successful investors design rules in advance. How much to invest? How often to invest? Under what conditions to change course? They automate good behavior. They reduce emotional decisions. They limit unnecessary action. They focus on process rather than prediction. Over time, they make fewer mistakes simply because their system prevents emotional reactions. The biggest shift happens when people stop trying to outsmart the market and start trying to outbehave their own impulses. When investing becomes boring, consistent, and calm, outcomes improve. Why most investors lose money is not a mystery. They try to time the market. They overtrade. They chase performance. They react emotionally. They abandon strategies too early. None of these mistakes come from lack of intelligence. They come from human psychology. When people understand this, they stop blaming the market. They stop chasing shortcuts. They start building systems that support long-term behavior. That is when investing stops feeling like a gamble and starts feeling like a process. If this explanation helped you see investing mistakes more clearly, share your thoughts in the comments. And if you believe this understanding can help someone in your colleague or friend circle, make sure to share it with them. Education grows when knowledge is shared. This video is created for educational purposes only. For more calm, practical, and long-term financial understanding, subscribe to Money Depth Insights. I am the Finance Guide, John Nell, and I will see you in the next session.